Are traditional banks moving in the direction of cryptocurrencies and vice versa? Are we seeing blockchain banks moving in the direction of offering traditional financial products? And what does this mean for the everyday consumer and investor? We're here to discuss these themes with Chiente Hsu. She is the CEO and co-founder of Alex, Automated Liquidity Exchange. She told me offline is the acronym for this company, a very innovative, up-and-coming DeFi platform. Welcome to the show, Chiente.
Thank you so much, David. Thank you for having me here today.
Yeah, exciting to talk to you because you have a background in traditional finance, and we're talking about, well, I was talking to a lot of people at the Miami and Paris blockchain summits, which I just attended, and a lot of people were talking about the theme of adoption from institutional investors. Well, another form of adoption that is not often discussed in the press is the adoption by people participating in finance. So a mass migration of people from traditional finance backgrounds like yourself into the crypto sphere. That is a form of adoption in itself. So tell us about your background. You worked at Goldman Sachs previously, and now you're, working in the blockchain space. How did you make that transition?
Sure. So I was born in Taiwan and I grew up in Vienna in Austria. And that's where I also received my PhD and I became a tenure track professor in economics and econometrics. So I had a very strong quant background, let's put it this way. Then I joined Wall Street more than 2 decades ago. I started at Credit Suisse, and then I joined Morgan Stanley as a head of quantitative investment strategies. And then in between, I also published a book called Rule-Based Investing by Financial Times Press. So what it is, these are all systematic investment strategies. But instead of written it as a smart contract on blockchain, these are written in a closed chain, basically. So I started getting interested in crypto because, after the 2008 global financial crisis, we started to experience the inefficiency of the traditional financial system, the overregulation, over-bloated middle, back office, et cetera, et cetera. Then I started this project, Alex, together with my wonderful co-founder, Rachel, who also came from Goldman. We started end of May 2021. So at the time, DeFi was gaining traction and growing attention. And the technical innovation achieved in, for example, EVM protocols are just, simply brilliant. But from our experience from the traditional finance and financial engineering, we know that there are some important contributions that the financial quants like us could provide to make DeFi even more robust. For the mass adoption, as you mentioned. So in particular, we know from the industry experience that the institutional investors are very, very close to fully embrace Bitcoin, but not nearly as comfortable, with other altcoins. So our vision, Alex's vision, is to build financial infrastructure on Bitcoin, and that's truly decentralized, permissionless, and universally accessible. So that's why we migrated ourselves from traditional finance into this very, very exciting new era of financial modeling, I would say, and that's the DeFi.
Okay, we're going to come up to two key words you talked about, which is smart contracts on Bitcoin and also permissionless. So we're going to talk about what these terms mean. But first, I want to go back to what you said about DeFi. So you came from a traditional finance space. Let's talk about DeFi versus CeFi. What do you think DeFi does now that traditional finance could not have achieved before? In other words, what void does DeFi fill in the traditional corporate finance world?
Right. So if you think about what DeFi is, right? DeFi is built on blockchain. And particularly, for example, for Alex, it's built on the most decentralized blockchain. That's Bitcoin. There are other chains such as, Avalanche, Solana, et cetera, very, very interesting blockchain as well. And what void we feel for traditional finance are really the decentralization of permissionless. So if you think about traditional finance, right, because of the overregulation, the biggest risk they face is counterparty risk and also the settlement time, right? Because of the counterparty risk, the traditional finance, they need to have a much, much bigger balance sheet in order to I would say, manage the counterparty risk. But if you build finance or the financial infrastructure on the public blockchain, you immediately solve two issues. Number one is you don't have counterparty risk because smart contract is instantaneous. And number two, because of that, you don't have those balance sheet requirements. So I would say so that's what DeFi will be ahead of TradFi in terms of these two issues. When it comes to corporate finance, we already see institutional adoption of Bitcoin by corporations, such as Tesla, MicroStrategy, Square, etc., etc. And as Bitcoin now catches up on the smart contract and application level as well, Bitcoin DeFi will provide enormously useful for the management of these corporate treasuries. So, for example, when it comes to funding, the traditional asset classes for corporate treasuries are, for example, corporate bonds, right? Now, soaring U.S. inflation will lead to high yield on bonds, meaning that the current bond holders will race for the exit, and these treasuries will be obliged to shift to alternative asset classes, such as cryptocurrency. Also, fundamentally, Bitcoin is regionally neutral. It's removed from this regional monetary economic policy that, direct other asset classes and markets, such as bonds. Now, particularly Bitcoin, it allows corporate treasury manage to navigate those traditional financial markets turbulence, I would say, particularly during the period of distress or market uncertainty. So all in all, I would say that the Bitcoin can solve lots of those dilemmas about market volatility, et cetera, et cetera. Bitcoin is decentralized foundation, ensure that the holders do not necessarily need to jump through all the, flaming hoops associated with the traditional centralized financial services.
Okay, well, just on your point about corporate bonds. So yes, you're right. Yields are going up, bonds are less attractive. But when an institutional investor is looking for a bond replacement, is there anything equivalent in terms of risk profile, risk and return profile in the crypto space that they can look towards? I mean, I don't see, let's say, a Fidelity or a Goldman Sachs asset management arm saying to themselves, you know what, let's forget the treasuries and buy Bitcoin. They're not equivalent, right?
Not yet, right? At the end of the day, the fiduciary responsibility of Goldman Sachs asset management or Fidelity is to make your money work, right? If they don't adapt the new technology, particularly in terms of alternative asset classes, they are not doing a good job for you, for our parents, your 401k, et cetera, et cetera. So the adoption is happening, is ongoing, and there's only one way, which is going up. Now, if you think about, for example, Bitcoin, right? If you put in a centralized exchange, you can get really exciting yield. If you think about, for example, the blockchain where Alex is built is a smart contract, built this protocol, stacks, right? If you stack the stacks, you get, I would say, close to 10% yield. Right? And this is just stacking on a very, very secure, decentralized blockchain.
You're talking about Bitcoin?
Yes,
okay.
Bitcoin and stacks, right?
Right.
So these are very interesting yield that if you are manage the money for the retiree, for the teacher, for the fireman, this is a yield you just cannot ignore, right? You have to make the money work. So that's what's happening right now.
Bitcoin has been performing so far similarly to tech stocks. So if you actually take the NASDAQ and you track the price of Bitcoin, they're very much correlated. So maybe this sounds to me like that's a Bitcoin on stacks with the yield. It sounds to me like a blue chip tech stock with a high dividend payout. Would you make that assessment?
I think there are two issues. Number one, definitely because this is a new area, new sector, the adoption is still very, very early, so the mass adoption is not there yet. That's definitely true. That's why you get a high dividend. Definitely, I agree with that. But also there's a second thing is that let's look at the usage, right? The use case of Bitcoin or other cryptocurrency is that definitely there's a use case. If, for example, remember last time we talked about if you're an Indonesia import-export company, you buy goods from Chinese factory, right? If you use cryptocurrency or even stable coins, the settlement is T+0, right? Right away, you can receive or pay the payment. So that's definitely the use case that fiat currencies cannot compete. Hence, the yield is higher.
Okay. Now, Someone might say to you, Chiente, well, that sounds fine, but if I wanted yield and stability, why don't I just, yield farm a USDT or USDC? Bitcoin is still more volatile. How would you respond to that?
So I would say definitely yes. Stable coins, the sound like stable coins, right? But I would put a little bit more attention because the stable coin is not the same as the other stable coins, right? So pay attention about where these stable coins come from. So that's number one. Number two is that, at the end of the day, Bitcoin is still the most decentralized blockchain, permissionless. So nobody can switch you off, right? You have this Bitcoin and nobody can say, okay, you can't withdraw your Bitcoin anymore. Whereas some stable coin is actually centralized, right?
Okay.
So somebody, a centralized authority comes to say, you cannot withdraw.
Okay. So maybe a traditional financial equivalent would be like, let's say this asset is a little bit more volatile, but it's got a AAA security rating, whereas the other ones are, maybe a little bit riskier, maybe higher default risk, a little bit, right? Would that be a fair analogy? Okay. You mentioned to me offline when we talked, Bitcoin is a good platform for smart contracts because it fits the criteria of being secure and transparent, which are two important ingredients for corporate finance. Can you explain or expand on that?
Yes. So we know that Bitcoin is the original blockchain, right? It's built to be the digital gold, as Satoshi phrased. So it was built to be a shared ledger that supports send and receive transactions. So it was built to be very resistant to change. Now, two main reasons why we think that a financial infrastructure or application like Alex should be built on Bitcoin, exactly as you said. For finance, we got to be very boring. For finance, you can't be that exciting, etc. You got to be boring because these are people's money. So security and transparency are a paramount concern. And because Bitcoin is the most decentralized and mutable blockchain in existence, we believe that for DeFi to achieve the mass production, both by individual as well as institutions, as you rightly point out, it must be built upon this rock of Bitcoin. And the reason why we chose to build on Stacks, which has a full expressive a smart contract for Bitcoin, is also because of its security. Its code, which is called Clarity, can be very easily read, understood, and is audited by third party. And also, it is a code where there's nowhere to hide, right? So interestingly, if a hacker injects a malicious code, the blockchain will show exactly, how the hacker did and what code they used. So this facilitated reversing the exploit. And in terms of transparency, the Stack Clarity, Stacks coding Clarity, which is a decipher language, and because it's not compiled in a machine code, it's executed exactly as it is written. So it's broadcast to the blockchain exactly as it is written. So that's why we chose to build our DeFi on Bitcoin via Stack smart contract, because we want to be boring, but because we think that security and transparency are the two most important characteristic for financial services like us.
Okay. You talked about how DeFi and Bitcoin is still in its early innings of mass adoption from institutional investors. Chiente, what is the macroeconomic catalyst for mass adoption to happen?
Macroeconomic catalyst, I think we're in the middle of it already. So number one, the inflation, right? It's not just the US. The inflation is popping up everywhere. So number one, when people experience inflation, what it means is that the $1 you earn today, tomorrow suddenly it becomes what? 90 cents, 80 cents. So people will lose their confidence in fiat currency. Now think about US at the moment is a world currency. Now, if you go beyond US, you look at Mexico, Argentina, those places that, they have experienced a hyperinflation is still in people's memory. Now, if they cannot peg their currency into dollar, they have to peg into something that they think is by nature deflationary, and that's Bitcoin. So we truly believe that right now, David, we are in the middle of the catalyst of the macroeconomic environment that enable the bigger adoption, more mass adoption of Bitcoin.
Okay. A lot of people, well, there are different schools of thought on whether or not inflation was caused by money printing, quantitative easing, or maybe caused by supply chain issues, whatever you believe. Let's take the monetary theory that money printing caused inflation. People say that dollar printing was the root cause of higher prices this year and last year. Suppose, Chiente, suppose we had a world in which monetary theory was, or our monetary system was governed by cryptocurrencies. Let's say Bitcoin was legal tender in the US, like it is in El Salvador and everywhere else. Now, as you know, Bitcoin has a maximum supply of 21 million coins, which will be minted by 2140. Suppose we have a system where our currency has a maximum cap. Do you think that would help stabilize CPI?
I am not sure why. I think one reason why Bitcoin attract lots of users, more and more users, and become more and more interesting as a digital currency because it's borderless, right? So if you want to choose one borderless world currency that is digital and is built on the most, again, decentralized blockchain, you have only one candidate, that's Bitcoin. Even you say that, okay, the US, let's say the Fed coming out tomorrow said, I write down in my memorandum that I will not print more than certain amount of US dollar per year, right? But still, this is just about US dollar. What about other countries? So the border by nature established, I would say, the obstacles for money to free flow. So I would still think that Bitcoin will have its stand.
I'm just making the argument, the counter argument, because you said that inflation has caused people to lose faith in the fiat currencies. Well, because our system is based on fiat currencies, most people don't have a choice but to use US dollars for their everyday life right now. Suppose we migrate to cryptocurrencies. Well, the same problem would happen, right? We will still have price appreciation. Wouldn't people lose faith in the underlying cryptocurrencies that they use?
Yeah, that's an excellent point. But remember, Bitcoin by nature is deflationary, right? Nobody can mint more Bitcoin, right? It's just there. It's just there. Just only this limited amount of Bitcoin that will be available.
Okay, that's a fair point. So let's talk about several sectors within the crypto space that are burgeoning and making waves in the media. First, the Web3 space. I was talking to a venture capitalist in Paris, and he has a fund that is only Web3 focused. This is the first I've heard of any VC. And venture capitalism is risky in itself, but he picked a very, very risky new sector. What do you know about Web3, and how is it changing our I guess, tech and socioeconomic landscape?
I would say Web3, the key words about Web3 is user owns the data. The creators own the art. I would say these are the two phrases I would characterize Web3. What it means is, for example, let's look at DeFi. Oh, that's the financial services, right? Let's compare Alex with Goldman Sachs. Okay. Now, Goldman Sachs is a centralized entity, with all its pros and cons. It has, asset management arm, it has trading arm, etc., etc. Now, all these services is built within the institution that's not open or transparent, right? So very, very Web2, right? You go onto Goldman Sachs Asset Management's website, right? You say, let put it differently, David, you have an account because you're high ultra net worth individuals, and you have an account with the Goldman Sachs Asset Management, right? Or private banking, right? The money you have there is actually not yours because it's not in your wallet, right?
What do you mean it's not mine? I still have custody over that, don't I? I can choose to redeem my funds anytime I want.
But sometimes they can tell you, no, you cannot redeem today, right? Because it's a promise. It's a contract between you and Goldman Sachs, the bank, saying that, if you need it, they have to give you the money back, right? So it's not in your wallet, right? You don't have really full control of it. And sometimes you withdraw something, it takes time, like T+2 kind of settlement, right?
Sure.
So that's very, very Web2. Let's say you go onto Goldman Sachs private banking website. Now you come to Alex, which is completely Web3. When I, using Alex app, I tell my mom, this is completely Web3. Why? Your wallet, David, is yours, and only you have the full control of it. When you use Alex, the financial services, just like Goldman Sachs has, for example, the exchange page, right? When you put a transaction in, you are putting it in and it's peer-to-peer. There's no centralized authority in between. Right? It's you and me, for example. We exchange Bitcoin with other stablecoin. It's peer-to-peer. Your wallet is yours. My wallet is mine. Nobody control us. So that's a very big difference between Web 2 and Web 3. Or let's come back to Facebook, or let's say now it's called what? Meta. Now, every time you use a Facebook, your data is not yours. It's Facebook's, and they make money out of the data that you provide to them. But it's very convenient for the user, right? We give them all the data and they become such a monster at the end of this Web 2 tunnel. If there were a social platform that's Web3 based, is completely decentralized, your data is yours. Nobody owns your data. All the identity is yours. Now we are still looking for that, that big step where there will be a application that can give us all this convenience, such as Facebook, but still data in our wallet is ours. So that we are still waiting for.
Okay.
So I would say Web3 can really disrupt all aspects of our life.
All right. Final question on this point, and I'll move on to the next topic. If you were to go to the Goldman Sachs private banking clients and say, Alex is better, okay? What is your message? How would you convince them to move to Web3? Maybe in one message.
Alex is better than Goldman Sachs because we built on the most decentralized blockchain. That's why we are more secure, and you are the owner of your wallet. Nobody can shut you down.
Okay. But what can I invest with on your platform?
Well, at the moment, you can invest Bitcoin, stable coins, and all other tokens that is native stacks. Very, very soon, we'll have bridges to Ethereum, to Solana, EVM compatibility, etc., etc., etc.
Okay. All right. Can you see a scenario in the future in which, let's say, a crypto exchange or platform like yourself can also host traditional assets like stocks and bonds just on the blockchain? Is that a concept that maybe you've thought about?
Absolutely, and it is happening already. A piece of paper that say you own certain share of certain company, that's just a piece of paper, right? That's just a promise. But you can digitalize all this ownership, and it is happening. Stock, bond, real estate, certificates, etc., etc. So the revolution is happening. People try to map the ownership of asset into a blockchain.
Let's move on to your book. You wrote a book before. Tell us about the theme of your last book, and maybe I think you're working on another one right now.
Yeah, so last book was called Rule-Based Investing. It's about how you can use a set of rules, so systematic modeling, to invest in different asset classes without any emotion. So that was the theme of the last book. The coming book will be about blockchain. So, obviously, it's still in a very early stage, but I'm planning to write a book about DeFi. I think finance, sometimes people like to use lots of jargons. So itself is a kind of, not that interesting topic. And then you put blockchain on top of it. So I'm working very hard, try to see that if we can come up with much simpler way to have a book that the people would like to read it, but also to help people, to help the education part of the Bitcoin DeFi.
Okay. Before I let you go, just apply some of the rules for investing that you wrote about in your last book into cryptocurrencies today. Very different asset class in terms of its volatility profile, very different asset class in terms of its use case and utility, something we've never seen before. Can the same rules for traditional finance be applied to investing and trading in cryptocurrencies?
Some, but not all. So, for example, the beta of crypto is very, very strong. So often if you want to diversify, the overall crypto risk is harder, right? So I would say diversification, we always say, is a king, but sometimes in crypto, portfolio management is harder. So that's number one. Number two, the volatility. You rarely say so. Now, volatility of Bitcoin itself is already, I would say, 20 times higher than S&P 500. So when you apply option type of strategies, either to enhance your return or to hedge your downside risk, it can be much more costly. So I'm sure you have heard of people, they kind of leverage too much when they bet on cryptos. And that's because, leverage itself is expensive. So when your leverage trade not working well, you have to pay the cost very high. So be careful about that. Otherwise, I would say the common sense will apply. I like to say, don't be a trader, be an investor, right? Be long-term, because we are still very early in the crypto adoption phase. So be an investor, don't be a trader, learn from history. You rightly say so, macro environment is very important. Risk on, risk off, all this you can learn from the history. And number three, don't be emotional. Apply your rule. If you say, this is my target, this is how I want to diversify my holdings, stick to it. Right, stick to it. Don't try to trade in and out every day. Don't let emotion override your decision making. Does that make sense?
Yeah, I guess unless you're a professional day trader, but that's a rule in itself, I suppose. But excellent. Let's follow up next time and talk more about these rules in greater detail in another segment. But thank you so much for coming on and talking about DeFi. Appreciate your time. Thank you.
Thank you, David. Thank you for having me.
And I'll speak to you next time. And thank you for watching Kitco News. I'm David Lin.